Hey, what's up, everybody? And today I'm going to talk to you about an interesting topic, cash. So here I have a $100 bill. Now, it is not deposited in the bank, and it is just in my wallet. So let's talk about some of the common beliefs about cash when it comes to investing. So before we dive into this video, I just finished having my Chinese New Year dinner. So I just wanted to say Happy Chinese New Year, and I wish you the best of luck for investing this year. So let's continue. Now, most of the time, when you're thinking about investing, you think of how much interest you can get when you put $100 in the bank. And right now, with the current economy, it is close to 0%. So you might be thinking, hey, my cash is doing nothing, it is wasted, and this is idle cash. And every day you don't invest, inflation is working against you. And with record low interest rates, housing prices in Canada and US is actually going up significantly. So if you hold cash in your bank account, it is not in a house, it is not in shares, then next year, this $100 will be less. It might be 90, it might be 80, or it might be 70 in a couple of years. How does that impact your investment strategy? So let's start with the first part, is the traditional view. Now, the traditional view of cash is that, well, you need it for emergency purposes. This might be emergency funds. This might be you need it for running your daily lives, like paying bills, mortgage, and whatnot. So in that case, you do need the cash, and don't put it in the stock market because it can fluctuate a lot. So you need the emergency funds first. Now, if you are having idle cash, which means you already cover your basic needs and you're living fairly comfortably, so then you start accumulating cash because you're also a frugal person like me, then you will feel like it is wasted in the bank because you're getting 0.1, 0.2%, or even just 0%. And some banks, they'll even charge you a fee for having the account, so then you're actually making negative interest. But instead, the bank is actually using your money, your deposit, and loan it out to other people, whether that is through credit card debt, or a personal loan, or a line of credit, and you're making nothing from it. So that's why you feel compelled to invest. So let's talk about the perception number 2. Timing the market is worse than time in the market. Or in other words, time in the market is better than timing the market. So traditional investing belief says that you should put your money in the market to work for you. And you don't need to time the market, you don't need to wait for a market crash, because chances are you wouldn't be able to predict a market crash anyways. So hopefully your $100 here will turn into $200 one day. And this is through the idea of compound interest, earning a return. So then you're making 7 to 10% a year. So then in 7 years or whatnot, you would double your money. And you will have a better retirement. And this is great. And if you look at majority of the mutual funds like S&P 500, NASDAQ or whatnot, it is very difficult to time the market. And I can confidently say, unless you have a very strong financial background or you're lucky, it is really difficult to time the market. So when should you time the market? Well, if you want to time the market and get a higher return, then that's when you dive into individual stocks. Because when you're looking at the market, it is really the average of thousands of stocks or 500 stocks or S&P 500. So it's really hard to time the dip, but instead you would time the dip for individual stocks. Because when you're looking at individual stocks, there might be certain events that impact those stocks specifically, which is easier to understand, easier to research, and easier to hop onto those opportunities when the time is right. So that brings me to the third perception. So if you are managing your own portfolio and you want to play the stock picking, stock investing game where you don't want to pay a mutual fund manager 1% or whatnot, and you want to do this yourself and earn a higher return, then this is where cash becomes important. Because when you're looking at the market, there's uncertainty. You don't know what will happen in the future. You don't know whether tomorrow the price will be up or down, but you might be able to find discounted stocks early on, and then you can invest in them. And you know you're not the perfect human being, so you understand when you enter into the market, you wouldn't be perfect. You might be a little bit too early, you might be a little bit late, but nevertheless, you know you're getting a good deal. So what you want to do is to separate your positions into multiple positions. So instead of going all in onto one stock at one time, you would separate your positions into 3, 4, or 5, and then enter it incrementally over time. Let me give you an example. Let's say you're buying a stock that is currently going down. So as of the time right now, it's PayPal. Now, you know PayPal is a good company. You do the financials, you analyze the company's products, roadmap going forward, and you know it's great. But then it is going down right now. And in fact, it is on a discounted price, kind of like 50% from the top. So you know if you get in long-term hold, you should be fine. But then you don't know if you're getting in too early. And to be honest, most people right now are getting in too early, myself included, which is why it is important to have a long-term view. So in another video, I'll talk about how to analyze PayPal and how to think about valuations as well. So if you want to learn more about that, then you can subscribe to this channel and wait for that video to come out. When you are thinking about PayPal, I might have allocated $100 to it. Do I enter all $100 today? Well, the answer is no. If you entered all $100 today and then PayPal drops subsequently, then you have no more money to buy anymore. So that's why it is important to first figure out what is the total amount of money you want to invest in a stock. Let's say it is $100. And then you would separate it into smaller portion. So here I only have $50 bills. So just work with me here. You might separate it into 2 portions, or if you are able to invest more, then you would separate it into 3 or 4 portions. By doing so, it gives you more chance to buy at a cheaper price. So let's say today you think the price has already dropped 50% for PayPal and you want to buy $50. So then you would do that and you would have $150 remaining in cash. And this is really important because even though your cash is not making money at the moment, this is your war chest. This is your inventory. If you are buying and selling e-commerce goods from China to US, cash is crucial because you need that money to buy inventory, sell it, get the cash back, and then you do it all over again, kind of like a cycle. In accounting, it's called inventory turnover. So you want to do the same thing for stocks. So you don't need to feel bad if you're holding onto cash, waiting for an opportunity. That is the key. If you know the opportunity you're waiting for, cash is crucial. Because if you invested all $100 today, and PayPal suddenly drops 17% after earnings, which is actually what's happening, then you might regret saying that, oh, I have no more cash to buy PayPal anymore. So then you want to have this cash remaining, so then after some key event, whether that's earning or product releases or whatnot, available to buy the stock you want to buy. So that's why I always have one very simple rule: never go all in. You do not want to go all in when it comes to investing, because even if you are very confident, you might be wrong. And here is a sad but important story. So I hop on a lot of calls with different investors, from amateur to professionals, and sometimes people will go all in. And in fact, it's actually very difficult to convince a person to not go all in when they have already gone all in into a stock. And in this case, it happens to be NIO. So this is a couple months ago, and NIO is an EV company that is currently growing quite quickly in China, but it is loss-making. So this individual, he really believes in NIO. He did his research, and he thinks that NIO will go up and double its price. And right now, he's underwater. So he went all in. But if you look at portfolio allocation and if you look at the big picture, even though you are really confident, I don't necessarily think you need to go all in. And if you look at the chart for NIO today, you'll realize that it has actually gone down a lot from a couple of months ago. So then that means your entire portfolio, the fluctuation of the entire portfolio is neo. So you're not really getting that diversification benefit. So if you have a lot of courage, if you have a very high risk tolerance, then of course that is fine. But then if you don't have that kind of risk tolerance to go all in, then that is a really bad strategy for your mental mind. So you might get really emotional, you might not be able to sleep, you might, get depressed or whatnot. And I have seen those cases where people lose a lot of money and they get depressed. So that's why it is so important to diversify, because when you're investing, you always need to consider, what if you're wrong? And if you start thinking that way, what if you're wrong, then suddenly you'll be more conservative, and you'll also allocate your portfolio out more so you don't take on too much risk. Because most of the time when you're investing, obviously you would think that you will be right. You're really confident. If you are not confident, you would not invest to start with. So that is really the key message here, is that you need to diversify. And you need to diversify when it comes to industry. You need to diversify when it comes to specific stocks, the time, so not going all in. And you need to diversify in terms of sectors and also black swan events. So those are usually the 5 factors I would look for when it comes to diversification. So you can look at your portfolio to see if it is too concentrated. So for example, in the last 1 to 2 years, if you are heavily invested into technology stocks like medium tech to larger tech, you'll see quite a drastic decline because the technology sector is getting hit. If you invested in energy in the last 6 to 12 months, you should be making somewhere between 25 to 100%, depending on which stock you're investing in. So obviously, this is a sector issue. It's not like you could have picked one cybersecurity stock over another cybersecurity stock to make it happen, or you can pick a e-health stock versus another e-health stock to avoid the loss. It's actually a whole sector issue. So the only way you could have avoided the recent technology correction is by investing in something that is not technology. So that is definitely something you need to consider and ride through. So back to cash. As a seasoned investor, the way I think about cash is quite simple. It is the same way as Jesse Livermore, one of the greatest day traders in the world, think about cash. Cash is your inventory. It is your war chest. You need it when there is an opportunity, but you don't know when an opportunity will arise. So that's why you need to have the cash available, not invested in something else. And when the opportunity arrives, you can invest and buy it cheap. So if you want to use a more American metaphor, then it would be like bullets. You have a handgun and you might have 10, 20 bullets. So you need to be very careful of how you shoot these bullets and make sure they hit the target, because you have a limited amount of them. So you might be able to save on a monthly or a quarterly basis to get more bullets, but then in the end, you'll only have so many bullets. So that's why you need to be very careful, very patient, and only when you think the opportunity is mature enough, then you invest. So what happens when you enter into a stock too early? So for example, right now I would say PayPal, if you bought PayPal earlier, then it is too early. So you need to think about what are some of the strategies you can implement for entering too early. So the problem with entering too early is that the stock will continue to drop even though you got in at a good price. So let's say PayPal was previously $300 and it dropped to $150, and you thought, hey, that's a pretty good price. So you got in at $150, $160 or whatnot, but you don't think it is going to be going up immediately. Obviously a lot of macro variables, interest rate is going up, it's kind of bothering the tech sector, the overall tech sector is down or whatnot. So that makes, a stock like PayPal not going up immediately. So then you'll need to have a strategy to mitigate that risk. Now, most people, they will just hold through it. If you are using shares, I think you can just hold through it. It might make you a little bit depressed in the short term or a little bit emotional, but If you hold through it, then it should be fine. Now, what if you're using something more advanced like options, which is what I do? So in that case, you really want to reduce the volatility in the short term. So that's when you want to introduce something called a hedge. So a hedge is the concept that if the stock goes down in the short term, you will still make money from a certain part of your position. So then you're not losing a lot. So that is the concept of a hedge. And it's basically like buying an insurance contract to hedge for a period of time where the stock might go down. So it's like paying for insurance for your car or your house is to prevent any bad things from happening. And there's a cost. So that's when you need to evaluate the costs and benefits of a hedge to see if it is worth it. So for example, you use $100 to buy a house, and how much money would you spend on insurance in case the house value goes down? Now, it might be fire insurance in real life, it might be car insurance, it might be life insurance, but you can also buy insurance for stocks. And that's what a put option is for. So you need to evaluate A, how much money you want to spend on insurance. Second, what is the time period you want to hedge for? It might be a week, a day, a few months, a year. So you need to figure out what is the appropriate period to hedge. So that is quite important. And once you figure that out, then you would want to enter the hedge position when you open your share position as well. When you enter into a position, you're really optimistic. You think, oh yeah, PayPal is going to go all the way to the moon to $600. And I'll explain why $600 in another video when I analyze the valuations of it. So it might go to $600, but of course not tomorrow. So it might go down, and that's why you need the insurance contract. And because you're so optimistic, most people will forget to buy the insurance. That is actually one of the biggest problems I see when it comes to investing, is that you don't know you need an umbrella until it starts raining. So that's why when you enter into the long position, like buy shares or options, you also should have a hedge if you know you're too early. Sometimes you can get away without a hedge, like for example in 2016, 17, 18, 19, you can probably get away without a hedge. But ever since COVID, 2020, 21, and right now 22, I strongly recommend having some sort of insurance in place in case the market goes down in the short term, because it is getting a lot more difficult to be right in the market, and it is more volatile and it is more unpredictable. So that's why you need to be more careful when you're investing these 2 years, because obviously the government policy and the Fed increasing interest rate is having a large impact on the economy and how the market reacts. So yeah, that's why you want a hedge and enter it into the very beginning parts of it. And if you think there's any special events coming up that you might think will lead to a decrease in stock price, you can also enter into a hedge as well. So you don't want to spend too much money on a hedge. And usually I would recommend spending around 5 to 10% of your book value on a hedge. And then if you make money, you can take the profit, and then that will actually lower the cost per share. And then you can enter into a hedge again, or you can just leave it as not hedged once you think the bottom is mature and the price is no longer dropping. Now, one of the questions you might ask if you're more familiar with options is whether you want to use a cover call. So for those of you who don't know what a cover call is, it's kind of like selling a contract that you'll make like $2-3 or 2-3%. If the price goes up a certain level, then you would give up your shares at that price and you would make a small interest on it. So it's kind of like a bond because you give up the upside to an investment, but then you make some interest. So a cover call is not a hedge because you only make a limited amount of gain. So a hedge using a put option is to cover a large decline in price, which then you need to protect your shares for. So for example, let's say PayPal after earnings, it drops 20% or whatnot. Then at that point, you want to hedge. So that's when you want to use a put option because the upside potential is unlimited. So then you can make back the decrease in your share price and reduce your average cost. And you need cash to hedge. And that's why you need to have idle cash remaining. So in case that later on in the future, if you feel like a position needs to be hedged, you can enter into it at a reasonable time before the bad news. So that's how I think about cash. And yeah, cash is important. So focus on saving. And when the opportunity comes, you need to be ready to pound on it. So I was rewatching the video and I wanted to give you one bonus tip when it comes to holding cash and how much cash you want to hold when it comes to investing. So this is something I teach in Investing Accelerator on how to prepare for the market crash. And basically, you want to hold cash based on how likely you think a crash will happen. So right now, I'm holding 10% cash. So for example, if you think in the near future, the next couple of months, a market crash will happen, let's say 10% of the time, then you want to hold 10% cash. If you think the market crash will happen like 30% of the time, then you want to hold 30% cash. It's quite straightforward, and this rule allows you to hold a different degree of cash over time based on your judgment. So if you think a market crash will be happening for sure in the next couple of months, like 100% of the time, then you want to hold 100% cash right now. So then the question comes down to, well, how certain are you a market crash is coming? And are you confident in giving up that potential gain between now until the market crash happening? And if you are able to have that insight after doing research, then you can hold that amount of cash. So for example, 1 to 2 months ago, I was holding on to 20 to 30% cash before the second tech correction. And then after the stocks drop, I maneuver my cash into specific positions. And then now I only have 10% cash remaining. So then I'm waiting for additional opportunities and then to enter it, so on and so forth. So that's how you think about the relationship between cash, market crash, and how to prepare for your next opportunity. So happy investing.